I'd like to welcome everybody to Agent's Role in Financing. This class has been approved for both sales associates and brokers. It's a 15-hour post-license education course. With that being said, let's go ahead and get into the material. The first chapter that we're going to be dealing with is the agent's role in contract preparation. And let me say this, the majority of all contracts that we're going to be dealing with, especially in residential real estate, is going to require financing. So real estate agents have to understand how to prepare a contract properly. There are two contracts that we deal with, the CRISP contract, which is the old FAR contract, and the FAR bar contract. The significant difference in the two is that the FAR bar contract is a calendar day contract. The CRISP contract is a business day, which means that when we're trying to determine how long it's going to take to get a loan approved, we have to factor that in. In most cases, we're going to give the buyer 5 days to be able to make application for the loan. Once that application is made, the default for the FAR bar contract is 45 calendar days to have a loan commitment. For the CRISP contract, that default date is 30 days. We should be able to get our loan approved within that time frame. But just remember that if the loan is not approved, as far as time is of the essence is concerned, and we don't get it approved within those time frames, that the contract actually becomes voidable. And that means that either party could withdraw. So we want to be very cognizant when we're preparing these documents that we make sure that we put the right time frame and not try to rush things. It's imperative to understand that if we rush contracts and closings, it'll come back and get us. Florida is a lien theory state, and let me explain what that means. Lien theory simply means that when a person goes down to borrow money from a bank, they will retain legal title of the property, but the bank will receive a mortgage. A mortgage is a collateral instrument. So the mortgagor, who is the borrower, will retain legal title. Most states that I'm aware of are are lien theory states. You may have one or two that are title theory, but not very many. Let's talk about the difference between a promissory note and a mortgage. A promissory note is a legal acknowledgement of a debt. And I think the easiest way to remember a note is that I'm saying that I owe you money. And the one thing about a promissory note is that we don't record promissory notes on public record. As a matter of fact, there's not even a place for a witness on a promissory note. And a word of caution, if somebody witnesses a promissory note, very likely you become a co-maker to that note. Now, along with a promissory note comes a mortgage. Now, let me say this, all the mortgage is a collateral instrument. You're pledging a property for collateral or security on that debt that you now owe for. A promissory note can stand alone, a mortgage cannot. So if you see a mortgage, you know there's got to be a debt somewhere. And let me give you the easiest way to remember the difference between a note and a mortgage. When you borrow money from a bank, you give the bank your property as a hostage. That's a mortgage. And the deal is this, is that when the bank has your property as a hostage, you've got a ransom note that you've got to pay. And as soon as you pay that ransom note back, they're going to give you your hostage back. If you fail to pay the ransom note, they will execute your hostage. And how are they going to execute your hostage? Your property? They're going to take it to foreclosure. In other words, they'll foreclose on you, take the property and sell it for whatever that debt is. As far as mortgage provisions, just remember that we have a lot of things that are contained in a mortgage. We have a number of things. One of the big issues is the prepayment clause that lenders talk about, that we talk about. You know, can you pay off your loan ahead of time? Well, let me say this, that a lender cannot collect a prepayment penalty unless it's very clearly stated within the mortgage document, the note document, that they have that legal right to do so. There's some other clauses as well, the acceleration clause, the due on sale clause, the exculpatory clause. Let me explain that one. We don't see that in residential transactions probably at all. What the exculpatory is, it's a non-recourse type loan. And what that basically means is that when somebody borrows money, that the lender can only look to the property for satisfaction if there's a default. So that means that they can't hold the individual liable in a deficiency judgment. There are also some other types of clauses that we have to deal with. One of them is a release clause, and I'm going to talk about that more in just a minute or two when we hit a blanket mortgage. But a release clause allows individual parcels to be taken out and sold separately. As far as mortgage assumptions are concerned, we don't have a lot of those today, but in those rare cases where a buyer-borrower comes in and assumes an old debt, I think it's important to note that that lender is going to require that person to sign a promissory note. Now, the significance of that is that when you sign a note, that's saying, I owe you money. The previous owner who just sold it and let this new buyer take over is still on a note. So what the lender's basically done is that they have now two parties that are liable for the note. And there's only one way that the previous owner or the seller of the property is going to be released of that obligation of the note, and that is if the bank is willing to give them novation. Novation is a release of liability. And as far as priorities of mortgage, I think the easiest way, or the priorities of liens, the easiest way to remember this is, when was it recorded? Whoever records first has a priority, and the only exception is superior liens such as tax liens. Those will always take precedence over any other type of lien. The repayment of loans. This is called amortization, and the standard amortization that we have today is a fully amortized loan. And what's basically happening is that the borrower is making payments every month of principal and interest. And as it goes along, as each payment takes place, that principal balance gets smaller and smaller. Now, the makeup of the mortgage payment, principal and interest, the principal portion every payment gets a little larger, and the interest portion gets a little smaller. And the reason for that is that the loan balance gets smaller. And at some point, I want you to take a look at page 1-7. There's an example of an amortization problem, and I'm sure that you're going to have to calculate one of those for the test. The adjustable rate mortgage is a loan that's made that may fluctuate with the market and typically will adjust every year. And it's based on an index and a margin. The index is established to determine how much it's going to go up and down. Margin is profit, and typically the margin is not going to fluctuate any at all. There's some other types of mortgages, and I'll tell you, the graduated payment mortgage, I remember when that was really an important mortgage. The FHA 235 program came out, and basically what it was where you made mortgage payments, but your principal and interest payment that you were making was not even sufficient enough to pay down the principal, much less principal and interest. And therefore what was being done was a negative amortization was being created. And what that simply means is that instead of your mortgage or your loan amount getting smaller, it was getting larger. Some of the other types of loans, we have the 15-year mortgage, the blanket mortgage, I mentioned that a little earlier. A lot of your builders and developers will do blanket mortgages. In other words, what they'll do is they'll buy a large tract of land and have one mortgage and note to secure that entire parcel. When they develop it and try to do lots within and to sell those lots off, the bank is going to require them, or there's going to be a requirement of a release from the bank so that they can sell individual lots off separately. Another type of loan that's become real popular lately, especially with senior citizens, and that is 62 years or older, is the reverse annuity mortgage. And basically what a person that is 62 or older is doing, they're borrowing on the equity of their home, and it's got to be their primary residence. There's some other types of loans. You've got your home equity loans. Also, let me say that the sale and leaseback has become very popular with a lot of your commercial buyers. And what they'll basically do is they'll go in and maybe build a property, and they'll move in, but in order to free their equity up, what they'll do is turn around and sell it to investors with a long-term lease back. And what that basically does is it frees up their capital, it gives them their money back, but yet they still have control over that property. That's about all we have for the first chapter, and what I'd like to do right now is do a quick review with you of that material that's important. Florida is a lien theory state which allows a borrower to retain legal title during the loan terms while providing the lender with a mortgage as security. A note is a legal acknowledgement of a debt and should not be recorded or witnessed. If the lender intends to charge a prepayment penalty, terms and conditions must be spelled out, otherwise the borrower can prepay that loan at any time without a penalty. The exculpatory clause prevents lenders from seeking personal damage from the borrower and can only look to the property for payment. The blanket mortgage is one loan that covers more than one parcel of real estate and is going to require a release clause in order to sell individual lots separately. Novation provides a release of liability from some obligation. Amortization is a systematic method of paying down a loan. You're paying principal and interest toward the reduction of the debt. The graduated payment mortgage creates a negative amortization because payments aren't sufficient to pay the full principal and creates that negative amount. The reverse mortgage allows persons 62 or older to borrow money on the equity of their primary resident. The sale leaseback allows property owners to free up equity while retaining control of the property. And that's the end of the first chapter's review.